If you're an investor, you're juggling between various things you can own. Problem with diversification is you're not diversified, because if you're owning 100 companies that are all currency derivatives and they're all driving, let's take the extreme. You own every company in Argentina and the peso went from 15 pesos to the dollar to 210 pesos to the dollar over the course of 4 years. Where's your diversification, right? You're correlated to the peso, and that's the first order correlation. In essence, the value of all your cash flows fell by a factor of 15 over 4 years. Now, the same is true in Turkey, but you could say, well, I'm not in Turkey, I'm not in Argentina. Well, you are in a way. You're in the US, and if the value of the US currency is cut in half, then everything you own that's generating US dollars, right, that's valued based upon the dollars, is also got its cash flows being discounted. So the number one thing you have to do is you have to actually come up with a discount rate over the next decade. And you have to then look at whether or not the thing you own is valued based on cash flows and what kind of currencies. Then you have to apply a discounted cash flow model. And what you conclude is just about everything, right, looks like a bad investment if it's valued based upon cash flows. Now, professional investors have a conflict of interest. The conflict of interest is, if you're a venture capitalist, you raised $1 billion to invest in private companies that are early stage. Is it risky? Sure it is. Do you have a choice? No. If you're a venture capitalist, you have to invest in private companies at early stage. So it makes sense to you. Would I do it, Sven? No, because there's a 99% failure rate. If you're a professional investor and your mandate is to invest in public equity, would I hold public equity? No, because half of it, or more than half of it, is currency derivative. But it makes sense for you because you're getting paid 1 or 2% management fee, right? So maybe you're a crypto venture fund. Should you invest in crypto? Not really, because there's 6,500 of them and 99% of them are going to go away. But if you have billions of dollars and you're getting paid 2 and 20 to invest in them, then you have a different situation. What if you're a bond fund? You've got $10 billion to invest in bonds. Would I hold bonds? No, but you've got $10 billion. So you've got a mandate and you've got strategic permanent capital. So the market is being driven by capital structures that have inertia, right? Like if you look at the returns of these guys.
The system is set up so money flows into particular vehicles, whether it's the best investment or not. That's just the mandate, right?
The pension fund might have money with a certain investor for a decade and they review it once every 1 to 3 years.
Yeah.
So there's a lot of inertia there. I think that you have to, whenever you're looking at anybody's advice, you just have to figure out, well, what are their biases? I mean, if I'm here to sell you trading advice, then it's in my best interest to come up with a trade every week. Like, on CNBC, they're giving you the trade of the day. Well, because they have a daily show. If they only had a show once a year.
Here's the yearly trade.
So here's the thing about Bitcoin. I've just got one idea, which is buy Bitcoin, hold it for a decade. Okay. So I don't really have a different strategy every day, every week, every month. 95% of the returns in Bitcoin over the last 9 years came in 2% of the trading days. I think Howard Marks did the analysis on the S&P, and they determined that there was like 1 trading day a year that accounted for 100% of the S&P yield for 20 years. Like there are 20 days that amounted to all of the return in the S&P over 20 years. If you miss the top 5 days of the year in Bitcoin, your return is 7% a year. And if you had those 5 days, your return is 147% a year. If you're a trader, it's very challenging. And if you have a short time frame, it's very challenging. I have a macro view, and I think that the single most important thing everybody needs to do is they need to take their portfolio and they need to ask the question, is it property or is it currency? Is it a currency derivative? Is it a partial currency derivative? Is it a substantial currency derivative? If it's a currency derivative, it's 95% or it's 5%, and it's a derivative of which currency? If the company has half of their cash flows coming from South America, you're owning a currency derivative of the real and the peso. And so you first have to do that modeling. Also, like take China. The Chinese are printing more RMB than the economy can handle. That's why they've got a capital control on the RMB. And so if you're owning equities in China, you own a CNY currency derivative. And then after you know that it's currency derivative, is the currency rate fair? Because the official currency exchange rate of the peso to the dollar in Argentina is like 100, but the blue market rate is 210. And the official exchange rate of Chinese currency is much stronger than the real rate would be. If you're willing to accept the illiquidity of not being able to move your asset out of the country in question, you can tell yourself you have a nominal gain in the asset. That's the first question. If it's a property, and like owning a football club can be a property. Disney traded as a property. People said, I don't really care what the revenues are or what the cash flows are. I mean, Disney owns all these great iconic brands like Marvel and Star Wars, and it's a property. I just want to own the intellectual property. The next question is, how scarce, how desirable is it? If it is the Disney and it is the dominant intellectual property, entertainment property in the Western world for the next 100 years, and you believe it, you can have some conviction, just like you can have conviction in London. Okay, do you have the same conviction in every other city? Is London, New York? Is New York as good as Kansas City? Is Kansas City, magic mile as good as a mile in the middle of Kansas? So, and is Bitcoin as good as some other crypto? My view is Bitcoin is the apex crypto asset. London and New York, are the apex real estate assets. Go figure. Disney must be the apex intellectual property asset. Somebody owns a drug, maybe they're the apex medical asset. Whatever you're doing, find scarce assets able to raise their price, or you can sell them in a decade for 10x what you bought them for if there's 10x as much money. And they're not reliant upon lots of labor and lots of energy, lots of motion, right? Because the one thing the world doesn't do that well is it doesn't move things around with high velocity at low energy cost in the year 2022, right?
Yeah.
Because of public policy.